Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Tuesday, the 24th of September 2024. So before we start our daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into our usual intraday technical outlook on the major cross asset classes, as usual, let's have a recap what has taken shape yesterday, today, and in terms of their cross asset class intraday performance as well, and also highlight a medium term and intermarket dynamics that is playing out in the market right now. So yesterday, what we see over here is that we do see a slew of PMI data releases. Why PMI data releases is important? Because it tells us a leading we call it indication in terms of economic growth on the various major economies, but that will actually impact more of a medium-term perspective in terms of the markets. So let's have a quick look at the economic calendar to have a look at what has taken shape yesterday in terms of the PMI releases. So for PMI releases, like I mentioned yesterday, this particular compiler called Make It, they tend to release 2 weeks ahead of monthly PMI data. So this month is September, so they release about 1.5 weeks ahead. So what I could see over here is in Eurozone. Okay, let me expand my screen. Yeah, it's already expanded. So in Eurozone over here, the data for Eurozone was rather lackluster, both from the manufacturing and the services perspective. So for Eurozone, manufacturing PMI data continues to contract in a contractionary mode. So what you could see over here is that it actually came below expectation. Market is expecting 45.6, but it came down 44.8, also way below July figure of 45.8. Not the July, August figure of 45.8. So if you look at the trend of the Eurozone PMI manufacturing component over here, it has starts to actually slowly decelerate and contract, all right, in the month of September. And also, if you look at for the services side of the PMI component, it also came down below expectation as well. Market is expecting an expansionary mode of 52.1, but it actually dipped down below 50.5 and also below 52.9 that was printed in August. So what we could see over here is that the market has indeed the services so-called activity in Eurozone has indeed starts to slow down dramatically or significantly. So like recall a particular recap for PMI data, anything that is above 50 and above is considered expansionary, but we need to look at the rate of expansion. So for the services rate of expansion, it starts to slow down, even though it's still hovering at 50.5, which is still in expansionary mode. So if you look at the trend over here, okay, it starts to actually, the growth has starts to actually decelerate. Yeah, even though it's growing, but it's growing at a deceleration pace, which is actually not good as well in terms of the services activity in Eurozone. So that actually explained to us why the Euro had a kind of a whipsaw movement yesterday. It actually tried to it came down, it sell off, but it tried to play a help right at the 20-day moving average at around the 111.50 level for the euro dollar. Why? Because that actually increased the propensity for ECB to actually ignite another rate cut before 2024 ends due to the lackluster state of Eurozone preliminary September flash services PMI and manufacturing PMI. All right. Then on the other hand, if you look at over here, is that for UK manufacturing PMI also dip as well. All right, a dip as well, but not as bad as in Eurozone. All right, so the manufacturing PMI for UK also dipped slightly lower, 51.5 from 52.5 that was printed in August, also below expectation of 52.5. The services side also dipped slightly, 52.8 from 53.7 in August. The market is also below market expecting of 53.5, but not as bad as the Eurozone in terms of the pace. So that's why the sterling dollar was much a clearer, a better currency as compared to the euro, as the sterling managed to help firmly above the short-term pivotal support that we highlighted yesterday. Later I'll touch on the short-term technical outlook on the sterling dollar, and it also hit our first resistance and rallied further up towards the 133.60 or 133.60 level. Okay. Later we'll touch more about that when we cover the short-term intraday technical outlook on the major dollar pair. So let us now focus more on what has happened yesterday in terms of the news flow. And in today's Asia session, we also see the release of this PMI data from Japan as well. Rather mixed bag over here. Manufacturing PMI data almost unchanged, 49.6, almost similar to 49.8 in August over here. But however, the services PMI improved slightly to 53.9 from 53.7 that was printed in August. And the most important news that takes shape in today's Asia session was this simultaneous, we call it aggressive interest rate cut by PBOC, which is this Bank of China, Public Bank of China, which is the China Central Bank. What he did is a rather aggressive interest rate cut over here. So simultaneous, because they actually cut, because no China, there's previous benchmark interest rate, so they actually cut simultaneously at the same time today. So what the China Central Banker announced, saying that they're going to cut another this reserve ratio requirement to free up more liquidity into the China banking system. That means reserve RRR, reserve requirement ratio, is the amount of money by China banks that is being held inside the PBOC China. All right. So if this ratio gets lesser, China banks need not hold so much money inside PBOC. That means they're allowed to actually loan out to customer demand. So they actually were to reduce by 50 basis point. Okay, 50 basis point, and it may cut further to 0.25 to 0.5% at an appropriate time. Okay, and on simultaneously, the 7-day reserve repo rate will be lowered by 1.5% from 1.7%. That means another cut of 20 basis point today. So that actually causes the China related stock market or benchmark indices to rally very strongly today, where we start to see the Hang Seng indices, which is considered as more of a higher beta China stock market play, rallied up by 2.6%. The Hang Seng Tech rallied up by 3%. The HSCEI, the H shares or the Chinese shares that are listed in the Hong Kong Stock Exchange, rallied up by 3% as well, much more higher than the China CSI 300, the A shares, which is up by 1.10% as we are speaking right now. So what we could see over here is that we do see a short-term positive animal spirit that's being unleashed into the Hong Kong stock market and the China stock market, at least from a short term to the medium term perspective. All right, so that is what's taking shape over here in the China stock market and the Hong Kong stock market, due to this simultaneous aggressive interest rate cut that is being enacted by the China Central Bank PBOC. And overnight, the US Federal Reserve, we see a slew of Federal Reserve Fed speak. That means the Federal Reserve officials giving their opinion on the state of the US economy. So Fed could sees many more rate cuts over the next year. And the reason why he actually warned is he's saying that because of a weakening labor market condition. Okay, and also another Federal Reserve officials, a Federal Reserve official, Kagasri, also expect 2 more quarter point cuts before 2024 ends. That means in November and December, another 25 basis point cut from him based on his expectation. And because right now he also mentioned that there's a risk of the US labor market weakening. So you say that the risk now tilted to labor market. So what you see over here is that it seems to us that yes, more interest rate cut coming up from the US Federal Reserve Fed, but that actually the reason for them cutting is because of the risk of softness in the labor market. That means, i.e., increasing risk of a recessionary scenario in the US economy. That also doesn't gel well to the US stock market. That means that actually giving a sign that the US Federal Reserve is late in enacting its interest rate cut cycle. So that also explains why yesterday US stock market was rather lackluster, not so much of a fanfare after Thursday very strong push up ex-post FOMC. So what you could see over here is that the SPX, the Nasdaq, the Dow Jones Industrial Average rather muted yesterday, closing only minimum gains of 0.3% to 0.15%, and the Russell 2000 was down negative 0.34%. And if you could look at the mega cap stock performance yesterday, was rather lukewarm as well. Okay, let me open up the heat map of the S&P 500. Okay, so what you could see over here is that a rather lukewarm performance in the mega cap stocks. So what you could see over here is that we see 3 mega cap stocks underperforming. Microsoft down negative 0.4%, Apple down negative 0.76%, down negative 0.76% for Apple, and Google almost down 1% at negative 0.95%. Nvidia up slightly 0.22%, almost on par with the Nasdaq and the S&P 500. And Metal and Amazon outperformed together with Tesla, which is up by a sterling of positive 5%. All right, so a rather lukewarm performance or mixed bag performance on the mega cap stocks yesterday in the US intraday performance due to fear of a recessionary environment that has already been kickstarted in the US. And after yesterday, US Federal Reserve official Fed speak hinting of a warning sign that the labor market in the US may have already starts to turn softer than expected. That's why they actually favored more interest rate cut going forward. Okay, so that's for now in terms of the news flow and their respective performance in the market. And I want to share with you, due to this the US dollar continues to remains rather mixed bag over here. What we could see over here, trading in the sideways range. So the dollar continues to remain strong against the yen over here, but rather muted against the euro and the Swiss franc. But the dollar continues to remain weak against the sterling, the Aussie, and the Kiwi. Rather mixed bag performance. And what we could see over here is that the dollar index continues to rather trap in this sideways range for now at 100. Okay, let me expand my screen at 100.60 and 101.90. Okay, this kind of sideways range configuration. But overall, the dollar continues to remain weak. It actually try to actually print lower high. Okay, lower high over here as of what we could see. All right, so rather mixed bag performance if you were to break down in terms of the dollar index. And if you could also dissect by the various major pair later, I'll share with you on the intraday technical outlook. All right, so now before we jump into the short-term intraday technical outlook, I want to share with you a medium-term fundamental and the intermarket dynamics that is more taking shape on the China-related stock market right now after this much more aggressive PBOC stance that is taking place or has taken shape today. That means more aggressive monetary policy stances by the PBOC that is going to weaken the dollar against the Chinese yuan. All right, so once this impact has been taken shape over here, we do see the Chinese yuan now strengthening against the dollar. Okay, against the dollar. All right, so this is a inverted the inverted pair. That means what I plot over here is the inverse of dollar CNH. That means this particular purple line is being quoted by one Chinese yuan equals to how many dollar. So as long as this line is sloping upwards, that means the Chinese yuan is strengthening against the dollar. And once it's strengthening against the dollar, it lead to a positive feedback loop into the China related stock market play. The higher beta being the Hang Seng indices, shaping a higher low right now. The HSCI as well as the Hang Seng index, the HSI. The one that is lagging behind is the CSI 300, which is the A shares that is lagging behind. All right, has not shaped a higher low, whereas the HS, the Hang Seng indices, has shaped a higher low over here, and that also been spilled over into the emerging market as well, and as well as other Asia Pacific stock indices, excluding Japan, that is also having this medium-term positive feedback loop that is being translated into them due to a stronger CNH against the dollar after this much more aggressive monetary policy stance that is being undertaken by the China Central Bank, which is PBOC. So something to keep an eye watch for from a medium-term perspective. That means, i.e., dollar is weakening against the Chinese yuan, or the Chinese yuan is strengthening against the dollar, by looking at this purple line over here, which I plotted the inverse by one Chinese yuan equals to how many US dollar. This Chinese yuan strengthening against the dollar has a positive feedback loop into the China related stock market, and it's more pronounced in the higher beta Hong Kong or Hang Seng stock indices, pretty much evident by the higher low that is being depicted in the Hang Seng index, the HSCI and the HSI over here. And the China CSI 300, the A shares is playing a catch up. Okay, something to keep a lookout for from a medium term perspective. That means, i.e., from a multi-week to multi-month perspective. So that's all for now in terms of the fundamental and inter-market analysis that I'll share with you. So now let us now jump straight into the short-term intraday technical outlook. So before that, let me expand my screen so that you guys could have a clearer look at the key levels. Starting with the FX market over here, okay, let's have a look at the euro dollar. So this what happened to the euro dollar whipsaw, okay, over here whipsaw around the 20-day moving average. So yesterday it broke below our short-term tighten short-term pivotal support at the 111.20 level, but managed to help at the 20-day moving average over here. So this scare over here, right, this little sell-off was due to the very bad PMI data on the Eurozone, both for the services and the manufacturing PMI that was released yesterday, giving much more impetus for the ECB to actually cut another interest rate before 2024 ends. So that actually explains the weaker state of the euro dollar. So with that, but managed to survive right at the 20-day moving average, bouncing up, but can't break above this 111.45 level that has taken down yesterday over here. Okay, this sell off, okay, can't break back above this level. So what I could see over here is a rather mixed bag performance on the euro dollar for today. So for today, on an intraday basis, I will have a neutrality stance on the euro dollar. So neutral between 111.45 and 110.90/70. Only an hourly close back above 111.45 will then reignite another bullish bias on the euro dollar to allow it to seek the next near-term resistance level at 112 figure level, but it got to break out above 111.45. So for now, having a neutrality stance on the euro dollar between 111.45 and 110.90/110.70, between these two zones over here. Similar for the sterling dollar. So the sterling dollar yesterday, we do see a very strong push up over here, this V-shaped recovery, hitting our first resistance at 133.60/133.80, but now it's coming to the top of this ascending channel already, this minor ascending channel top, which I drew from the low of 12th of September. So there could be a risk of another minor pullback taking shape for today. So I will actually turn neutral on the sterling dollar for today between 133.60/133.80 and 132.60. So neutral between 133.80 and 132.60 for now on the sterling dollar, unless the sterling dollar has a very clear bullish breakout above 133.80, if hourly close above 133.80, then potentially we could see a acceleration of this impulsive up move on the sterling dollar to actually expose the next near-term resistance level at 134.35 next. So that's for the sterling dollar. And right ahead, before RBA meets today, where market is expecting no change, no cut on its interest rate, we call it policy rate, the Aussie dollar continues to remain bullish, in a bullish dynamic. Over here, hitting our first first resistance level at 68.50 that we highlighted yesterday. So what I'm going to do over here is that today price action starts to bounce. So I will actually tighten the key short-term pivotal support level to yesterday's low, which is also the lower limit of this minor ascending channel that I drew from the low of 11th of September. Okay, so this will be the low, which is our pivotal support for today, 68.06. So 68.06 will be my Titan key short-term pivotal support for today on the Aussie dollar. So looking for a still maintaining that intraday bullish bias on the Aussie dollar. So next up, the resistance to watch will be this key medium term slash major resistance at 69 figure level. So this level is pretty key. Why? Because it was a switch to the daily chart, which I highlighted yesterday. This is indeed the former swing high of 15th of June last year, where the Aussie dollar can't break above this 69 figure level, and as well as this long-term descending trend line from the high of February 2021. So that was about 3 years ago resistance as well. So this level is pretty key. So I consider this as a medium term slash major resistance level. Unless this level clearly surpassed to the upside, that means we need to have a daily close above this 69 figure level, then we could consider more further potential upside on the Aussie dollar. So on an intraday basis, for now, this is the next resistance level to watch on the Aussie dollar at the 69 figure level max. Where my Aussie dollar chart? Okay, this Aussie dollar maximum level to actually look out for on an intraday basis to maintain our intraday bullish bias. But however, if price action starts to break down with an hourly close below 68.06, then this intraday bullish bias on the Aussie dollar will be invalidated to kickstart a minor corrective decline scenario to revisit the 20-day moving average that is now acting as a support level at 67.40 slash 67.30 next. Okay, so that's for the Aussie dollar. Now, turning our attention next will be the dollar yen. So the dollar yen continues to be actually play around with our short-term pivotal support level yesterday. A bit of whipsaw, so we have a bit of excess. 43.70 slash 16 level. So 16 level will be the intraday low that was printed yesterday, and also the 20-day moving average that is acting as a support level as well. So no change, still maintain that intraday bullish bias on the dollar yen in looking for this extension of this mean reversion rebound within its medium term downtrend that is still intact since the July high. So this mean reversion rebound is still in play since the low of 16th of September. And if we could do a trend line over here, not trend line, channel, a parallel channel that I draw. Okay, the top of the channel coincides with the resistance level that we highlighted yesterday, 45.40 slash 45.95. So net overall, perhaps we could have a minor resistance that was yesterday high for today. So two levels to watch for today on the upside. 145 figure level above it potentially sees 145.40. So still maintain that intraday bullish bias for this mean reversion rebound scenario to play out, holding above 43.70 slash 43.16 short-term pivotal support level. However, if price action starts to have an hourly close below 143.16 level, then this intraday bullish bias will be negated to kickstart a potential impulsive downward scenario again for the dollar yen to revisit the next near-term support level at 14140, followed by 13970 in the first steps. So that's for the dollar yen. All right, and that also sum up the intraday technical outlook on the major dollar pair. So I mentioned earlier that the euro seems to be getting weaker due to the fact of a fundamental weakness in the eurozone PMI data. So there's this particular cross pair that I want to share with you all, which is the euro Swiss pair. All right, so the euro Swiss pair continues to trade within a medium-term downtrend as price action reacted off from bearishly on the 50-day moving average yesterday. So with that, price action also broken below a former minor trend line support that I drew from the low of 11th of September. So this is an hourly chart on the euro Swiss, the euro Swiss pair, cross pair. So using 94.40 as my short-term pivotal support resistance level. I repeat again, using 94.40 as my short-term pivotal resistance level on the euro Swiss cross pair, which also correspond to the pullback resistance of this former minor trendline support level. Bearish bias on the euro Swiss on the intraday basis. Next near-term support level to watch 93.50 followed by 93.40. Only an hourly close above 94.40 short-term pivotal resistance level will invalidate the bearish bias on the euro Swiss to see the next near-term resistance coming in at 95.65 and potentially revisiting 95 figures / 95.20. Okay, so that's for the potential intraday technical bearish setup on the euro Swiss FX cross pair, taking advantage of the ongoing fundamental weakness in the eurozone economy. Okay, so with that, now let us now focus our attention to the short-term intraday technical outlook on the major global stock indices, starting with the Hang Index. So the Hang Index continues to be bullish, all right, over here. So yesterday already, we have a tightened short-term pivotal support level at 18,200. Today, price action continues to burst up, hit our first resistance level at 18,650. So still no change. Price action still showing no signs of a bullish exhaustion as RSI continues to hover at the overbought level. No clear signs of a bearish divergence as well over here. Okay, price going to hit higher high on the RSI. Okay, so with that, we will continue to maintain our intraday bullish bias on the Hong Kong 33 index, which is i.e. the Hang Seng Index, using a tightened key short-term pivotal support level for today, 18,430, which is very close to today's gap up level as well. So as long as this 18,430 short-term pivotal support level holds, next resistance to look out for 18,980. Followed by 19,330, which is the minor swing high of 22nd of May. Only the price breakdown with an hourly close below 18,430 will invalidate today intraday bullish bias on the Hong Kong 33 to see the price action shaping a minor corrective decline scenario to revisit the next near-term support level at 18,200, followed by 17,950 next. Okay, so that's for the Hong Kong 33. Now, turning our attention to the Japan 225. So the Japan 225 has now started to turn sluggish by the failure to break above the first resistance that we highlighted yesterday at 38,620, and the RSI now shaping a bearish configuration by the breakdown of this parallel trend line support level. Then there was a bearish reaction of it in yesterday's US session. So with that, a bearish element that is being depicted by the hourly RSI, which is a momentum indicator, indicating that the bullish momentum has now turned weak. And with that, we will have a short-term pivotal resistance using yesterday's high, 18,620 level, can't break above during the US session as well. After a test of it, in today's Asia session, it continues to print lower low. Okay, a lower low. So 38,620 short-term pivotal resistance level on the Japan 225, i.e. the Nikkei 225, flip to a intraday bearish bias for this minor corrective decline to play out on the intraday basis. A breakdown below 37,880 exposes the next near-term support area at 37,410 level, maximum 37,090, which confluence with the 20-day and the 50-day moving average. Only a reversal back up with an hourly close above 38,620 will negate or invalidate today's intraday bearish bias to see the price action pushing up further towards the next near-term resistance level at 39,270, which is this congestion area over here of 27th of June, followed by this 31st of July. So that's sum up the intraday technical outlook on the Japan 225. Shifting our focus, next will be the German 30. So the German 30, the RSI also starts to actually turn bearish as well, having a bearish reaction of this former parallel trendline support now turns into a pullback resistance level, indicating weakness of the bullish momentum that has taken shape yesterday on the German 30 index. All right, so with that, I will flip to a bearish bias for today on the German 30 using 18,970 / 19,050 as my short-term pivotal resistance level. First support level to watch on the intraday basis, 18,800, followed by 18,690. So that was yesterday's low, which is also corresponding to the 20-day moving average. Only a further breakdown below 18,690 for today, that means an hourly close below this level, will ignite further weakness towards the next support level at 18,390, we're also confluencing with the 50-day moving average as well. I think it's a support level. Only a price push up with an hourly close above 19,050, then that will invalidate today's intraday bearish bias to see the continuation of the impulsive upmove sequence towards the next resistance level, which is the one-time Fibo extension level taken from the low of 11th of September, project it to 17th of September, push it down to the swing low of 17th of September, like I did over here, with the acting as a Fibo extension resistance level of one time at 19,230 next. Okay, so that's for the German 30. Turning our attention now to the US major stock indices, starting with the US Wall Street 30. So the US Wall Street 30, the RSI has now starts to shape a bearish divergence over here. Okay, so with this bearish divergence, I'm not so convinced that the US Wall Street 30 now may actually shape higher high towards 42,730. All right, so with that, we will flip to a neutrality stance for today on the US Wall Street 230. So neutral between 41,950 and 42,335 / 42,410 level. Okay, unless we see a clear breakout above 42,410 level with an hourly close above this level, then this impulsive upward sequence will continue to seek the next near-term resistance level at 42,730 next. So that's for the US Wall Street 30. Now, turning our attention to the Nasdaq 100. So the Nasdaq 100 continues to trade in a sideways region as well, and also the RSI has started to flash out a lackluster observation by shaping a series of higher lower high as well. So with that lackluster reading on the hourly RSI indicating a lack of bullish momentum, we will flip to a neutrality stance on the Nasdaq 100 for today. So neutral between 20,000, that is the level that Nasdaq 100 have failed to break out, and also yesterday's Friday minor swing low at the 19,630 level. So neutral between 20,000 and 19,630 for today on the Nasdaq 100. All right, so now with that, let's sum up the intraday technical outlook on the major stock indices. Now, with that, let us now turn our attention to the commodities market, starting with gold XAU / USD. So still recall gold XAU / USD, we do have a key short-term pivotal resistance level at 2,640. So still no change. Over here, we do see a bearish divergence that has been being flagged out. Okay, over here, there's a bearish divergence as price continued to shape higher high yesterday. So still can't surpass the 2,640 level. So we still maintain this short-term intraday bearish bias for this minor pullback scenario, not a medium-term bearish reversal, but just a minor pullback scenario within its short and medium-term uptrend that is still intact. All right, because price action continues to trade above the 20 and the 50-day moving average, and there's no clear bearish exhaustion sign that's being seen on the daily chart as well. So with that, no change, still using 2,640 as my short-term pivotal resistance level to maintain that potential short-term minor pullback scenario that could potentially play out on gold, XAU/USD. First support level it got to break down will be 2,615 that managed to survive yesterday. So a breakdown below 2,615 may expose the next near-term support level at 2,591 followed by 2,575. So this zone over here potentially may kickstart another round of impulsive up move next. But now in first step, look out for this potential minor corrective pullback to play out first, but it got to break down below 2,615 for today in order for this minor pullback scenario to increase its probability. However, if a price break up above 2,640, that means for hourly close above it, then we got to respect this ongoing impulsive up move sequence for the gold XAU/USD to seek the next near-term resistance level, which is the one-time Fibo extension level at 2,664 next. Above it exposes 2,692, which is another Fibo extension level at the 1.236 and the cluster zone at 1.236 from another degree. Or for another angle. So that's for gold, XAU/USD. Now, lastly will be West Texas crude oil. So West Texas crude oil yesterday, it managed to come down and do another round of whipsaw back up again. Bearish reaction of the 73.15 short-term pivotal resistance level. So still no change. Still, this is indeed a short-term pivotal resistance level to watch. So still looking for another leg of bearish move on the West Texas oil as long as 73.15 short-term pivotal resistance holds. First near-term support level to watch for today will be today's Asia session low, currently at 71.58. A breakdown below 71.58 exposes 69.90/68.90 next. Only an hourly close above 73.15 will invalidate today's intraday bearish bias on West Texas oil to see a further potential extension of this mean reversion rebound that is in place since 11th of September. If it does a break above 73.15 to expose the next near-term resistance level at 75.07 next, which corresponds to the 50-day moving average, and as well as this medium-term descending channel resistance that I drew from the high of 18th of July. All right, so that sum up the intraday technical outlook on West Texas oil and as well as the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar or what are the key data to look out for today, other than RBA interest rate decision that's going to be out at 12:30 p.m. Singapore time, and also the press conference by RBA Governor Bullock at 1:30 p.m. Singapore time. So very likely this shouldn't be a big surprise, 4.3% unchanged, but the focus will be during the press conference 1 hour later at 1:30 p.m. Singapore time to see whether RBA Governor Bullock still continues to maintain her rather hawkish rhetoric that continues to see risk of elevated services inflation in Australia. So something to keep a focus on, which is 1:30 p.m. Singapore time. Then thereafter, during the European session, we do have one second tier data, not first tier. 4 p.m. Singapore time will be the business condition, confidence or climate, they call it, the info current condition and business climate for the month of September up at 4 p.m. Singapore time. Then we do have a second tier US data, which is the housing price index out at 9 p.m. Singapore time, and as well as conference board consumer confidence at 10 p.m. Singapore time. So no Fed speak for today over here, so that should actually sum up today's calendar. And but do take note that tomorrow early Asia session, one particular data that could impact the Aussie dollar will be the monthly CPI indicator that is out at 9:30 a.m. Singapore time, and market is expecting this CPI data to actually dip slightly lower to 2.8% on an annualized basis in the month of August from 3.5% that was printed in the previous month of July. Okay, so will sum up today's intraday. That will sum up today's daily dose of market insights. I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.